When it comes to taxes, the thought of an IRS audit can be intimidating. But what actually triggers an audit and what doesn't? In this video, we'll break down the most common reasons the IRS might take a closer look at your tax return, as well as some myths that simply aren't true. By understanding the real triggers, you can file your taxes with more confidence and less worry. Let's start by understanding what an IRS audit is and why it happens in the first place. An IRS audit is essentially a review of your tax return to ensure all information is accurate and complete. The IRS uses audits to verify that taxpayers are reporting their income, deductions, and credits correctly. Audits can be conducted by mail or in person, and while they may seem daunting, most are resolved quickly. Understanding the audit process helps demystify the experience and reduces unnecessary anxiety. Not all audits are triggered by mistakes or suspicious activity. Sometimes, the IRS selects tax returns at random as part of their compliance research. However, most audits are the result of certain red flags or discrepancies in your return. Knowing the difference between random selection and red flag triggers can help you understand your risk level and take steps to avoid unnecessary scrutiny. One of the most common audit triggers is reporting a high income. The IRS pays closer attention to returns with higher earnings because the potential for underreporting or errors increases with income. If you earn significantly more than the average taxpayer, your return is more likely to be reviewed. However, this doesn't mean you'll automatically be audited, just that your risk is higher. Failing to report all your income is a major red flag for the IRS. They receive copies of your W-2 seconds, 1099s, and other income documents, and their systems automatically match these against your tax return. If there's a mismatch, it's likely to trigger an audit. Always double-check that you've included all sources of income, even those from side gigs or freelance work. Claiming deductions that are unusually large compared to your income can raise eyebrows at the IRS. For example, if you report a modest income but claim very high charitable donations or business expenses, the IRS may want to verify that these deductions are legitimate. It's important to keep thorough records and receipts to back up any large deductions you claim. Self-employed individuals and those who run cash-heavy businesses are more likely to be audited. The IRS knows that cash transactions are harder to track, so they pay closer attention to these types of returns. If you're self-employed, make sure to report all your income and maintain accurate records of your expenses and receipts. Claiming a home office deduction can be a legitimate way to lower your tax bill, but it's also a common audit trigger. The IRS wants to ensure that your home office is used exclusively and regularly for business. If you claim this deduction, be prepared to provide documentation and a clear explanation of how you use the space. Charitable donations are a great way to give back and reduce your taxable income, but claiming amounts that are unusually high compared to your income can trigger an audit. The IRS compares your donations to averages for similar income levels. If your donations are much higher, you may be asked to provide receipts and proof of contributions. Claiming dependents can provide valuable tax benefits, but mistakes or intentional misreporting can lead to an audit. The IRS checks for duplicate Social Security numbers and other inconsistencies. If you share custody or have complex family situations, make sure you're following the rules and have the necessary documentation. Simple mistakes like math errors or typos can trigger an audit or at least a notice from the IRS. Their systems are designed to catch inconsistencies and errors in calculations. Double-check your math and ensure all numbers are entered correctly before submitting your return to avoid unnecessary attention. If your tax return is filled with round numbers like $1,000 or $5,000, it can look suspicious to the IRS. Real expenses and income are rarely so neat. Using exact figures from your records shows accuracy and reduces the chance of your return being flagged for review. Claiming that a vehicle or other asset is used 100% for business is a common audit trigger. The IRS knows that most people use their vehicles for both personal and business purposes. If you claim full business use, be prepared to provide detailed logs and evidence to support your claim. Having foreign bank accounts or assets isn't illegal, but failing to report them properly can trigger an audit. The IRS requires taxpayers to disclose foreign accounts and may impose hefty penalties for non-compliance. If you have assets overseas, make sure you understand the reporting requirements and file the necessary forms. Withdrawing money from retirement accounts before the eligible age can result in taxes and penalties. If you take early withdrawals, the IRS will want to ensure you've reported them correctly and paid any required penalties. Failing to do so can lead to an audit or additional tax assessments. Depositing or withdrawing large amounts of cash can draw attention from the IRS. Banks are required to report cash transactions over $10,000, and frequent large transactions may prompt further investigation. If your business deals in cash, keep meticulous records and be prepared to explain the source and use of funds. The IRS receives information from employers, banks, and other institutions. If the income or information you report doesn't match what third parties report, the IRS will likely flag your return for review. Always check your forms and make sure your numbers match what's been reported to the IRS. Reporting business or rental losses year after year can raise suspicions. The IRS may question whether your activity is truly a business or just a hobby. If you consistently claim losses, be prepared to show that you're operating with the intent to make a profit and that your expenses are legitimate. The IRS has specific rules for distinguishing a business from a hobby. If your activity doesn't show a profit in at least 3 out of 5 years, it may be considered a hobby, and deductions could be disallowed. Understanding these rules can help you avoid audit issues and ensure you're claiming deductions properly. If you file a Schedule C to report business income and expenses, your return may be subject to extra scrutiny. The IRS knows that self-employed individuals have more opportunities to overstate expenses or underreport income. Accurate records and honest reporting are your best defense against an audit. Owning rental property can complicate your tax return. The IRS looks for accurate reporting of rental income and legitimate expenses. Large losses, especially if claimed year after year, can trigger an audit. Make sure you're following the rules for depreciation, repairs, and other deductions. Recent tax law changes have affected how alimony is reported. For divorces finalized after 2018, alimony payments are no longer deductible by the payer or taxable to the recipient. If your return includes alimony, make sure you're following the current rules to avoid confusion and possible audit. The Earned Income Tax Credit is a valuable benefit for low and moderate income workers, but it's also a common source of errors and fraud. The IRS carefully reviews EITC claims, especially if there are inconsistencies in income or dependent information. Make sure you qualify and provide accurate information. Requesting a large refund isn't a trigger by itself, but if the refund is due to questionable deductions or credits, the IRS may take a closer look. Double-check your calculations and make sure you're entitled to all credits and deductions you claim. Filing an amended return to correct mistakes is perfectly legal, but it can increase your chances of being audited. The IRS may want to know why changes were made and whether the original return was accurate. Be sure to provide clear explanations and supporting documentation with your amended return. Certain industries are more likely to be audited due to higher rates of cash transactions or common deduction errors. For example, restaurants, construction, and taxi services often face more scrutiny. If you work in a high-risk industry, be extra diligent with your records and reporting. Using tax protester arguments, such as claiming that income taxes are unconstitutional, will almost certainly trigger an audit and may result in penalties. The IRS has seen these arguments before and takes them very seriously. Always follow established tax law when filing your return. If the IRS suspects your identity has been stolen or your return is fraudulent, they may audit your return or freeze your refund. Signs include multiple returns filed under your Social Security number or suspicious changes in your filing patterns. Protect your personal information and monitor your tax records for unusual activity. The IRS uses sophisticated computer programs to screen tax returns for anomalies. These systems compare your return to statistical norms for similar taxpayers. If your return stands out, it may be flagged for further review. This process is automated and helps the IRS focus on returns with the highest risk of error or fraud. The IRS's Discriminant Function System, or DIF, assigns a score to each tax return based on its likelihood of containing errors or fraud. Returns with high DIF scores are more likely to be audited. While the exact formula is secret, we know that unusual deductions, mismatched income, and other anomalies can increase your score. The IRS's Information Document Matching Program compares the information on your tax return to the data they receive from employers, banks, and other sources. If there's a discrepancy, your return may be flagged for review. This automated process helps the IRS catch unreported income and other errors. Now that we've covered what can trigger an audit, let's talk about what doesn't. Filing electronically, using tax software, or hiring a professional preparer does not increase your audit risk. In fact, these steps can reduce errors and make your return less likely to be flagged. The IRS is focused on accuracy, not the method you use to file. Filing your tax return early or close to the deadline does not, by itself, trigger an audit. The timing of your filing is not a factor in the IRS's audit selection process. What matters most is the accuracy and completeness of your return. Taking the standard deduction instead of itemizing does not increase your audit risk. The IRS does not favor one method over the other. Choose the deduction method that makes the most sense for your situation and keep records to support your choice. Receiving a tax refund is not a trigger for an audit. The IRS issues millions of refunds each year, and the size of your refund alone does not affect your audit risk. What matters is that your return is accurate and your refund is legitimate. Requesting an extension to file your tax return does not increase your chances of being audited. The IRS understands that sometimes more time is needed to gather documents or complete your return. Just be sure to file the extension properly and submit your return by the new deadline. The method you use to pay your taxes, whether by check, online transfer, or other means, does not affect your audit risk. The IRS is interested in whether you pay the correct amount, not how you pay it. Hiring a tax preparer or accountant does not increase your audit risk. In fact, professional preparers can help you avoid mistakes and ensure your return is accurate. Just make sure to choose a reputable preparer and review your return before submitting. Whether you file jointly with your spouse or separately does not, by itself, trigger an audit. The IRS is more concerned with the accuracy of your reported income and deductions. Choose the filing status that is best for your situation and ensure all information is correct. There are many myths about what triggers an IRS audit. For example, some people believe that claiming certain deductions or filing at a certain time will automatically get you audited. In reality, the IRS uses a combination of data analysis and random selection. Understanding the facts can help you avoid unnecessary worry. While you can't eliminate the risk of an audit entirely, there are steps you can take to reduce your chances. Always report all income, double-check your math, keep thorough records, and avoid exaggerating deductions. Filing an accurate and honest return is the best way to stay off the IRS's radar. If you are selected for an audit, don't panic. Respond promptly to all IRS requests, provide the documentation they ask for, and consider seeking professional help if needed. Most audits are resolved quickly, especially if you cooperate and have good records. Remember, an audit doesn't mean you've done something wrong. Good record keeping is your best defense against an audit. Save all receipts, statements, and supporting documents for at least 3 years. Organized records make it easy to respond to IRS questions and prove the accuracy of your return. Above all, honesty is the best policy when it comes to your taxes. The IRS is looking for accurate and truthful reporting. If you make a mistake, correct it as soon as possible. Being upfront and transparent is the best way to avoid problems and resolve any issues quickly. To sum up, IRS audits are triggered by a combination of red flags, random selection, and computerized screening. Most taxpayers will never be audited, especially if they file accurate and honest returns. By understanding what does and doesn't trigger an audit, you can file your taxes with confidence and peace of mind. Remember, knowledge is your best defense against unnecessary worry.